Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, Sutphin Properties, the Wyckoff Organization, Extreme Construction and Deconstruction.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State Region. You know, everybody, with the exception of one of my guests, has been a little pessimistic about the market. The credit market is difficult. You know, certain people sitting here might think we're in a recession. Certain people have a different attitude. But I really assembled today a group of individuals who are going to give me their perspective of what they see happening at the end of 2007 and 2008. My guests today include Michael Fascitelli, President of Vernado Realty Trust, Norman Sterner, Managing Member of Murray Hill Properties, Jonathan Urimak, Principal at Broadway Partners, and last but not least, he called me, I can call you Macha or Chairman of the Board of Lifestone Group, David Lichtenstein.
Thank you.
So, David, earlier today I had the opportunity to have you and Michael participate in my class at NYU. Are we in a recession? What's happening? Where do you see?
I can't tell you whether we're in a recession or not, but I could tell you some thoughts for '08.
I want to hear. See, I kept the apple, and I really was shining it up because I wanted the crystal ball, you know. So tell me if you win the apple.
There may be some people who need that apple at the end of '08. I think New York is particularly in a sensitive spot right now, more than a lot of other areas in the country. And that is because the financial drivers to New York have substantially been, for the last number of years, the financial industries. The financial industries have laid off 45,000 people to date, and from what I hear on Wall Street, they're going to lay off between 45 and 100,000 by the end of the first quarter. Now, if you figure that every person is 200 square feet, that means we're looking at 20 to 30 million feet of vacant space. Not necessarily vacant, but unused, shadow, dark, whatever the euphemism you may want, space, sort of coming into the market in '08. Now, what does that mean? Manhattan real estate is always going to be valuable. It's an island. It's very hard. There's big barrier levels of entry. So there's never going to be fire sales in Manhattan. What's happened is buildings that I know across the street from where I work on the corner of 57th and Park, they were asking $160 a foot 3 months ago. Today you can get the same space for $110 or $120 a foot. That's a 30% discount.
He's going to have a big problem. He's been paying those prices for these buildings.
Well, I think that the guys who are in at a very low basis or a sustainable basis are going to be fine. But the guys who've bought based upon '08 going up as '07 and as '06 went, are going to have, there's going to be real blood in the street. And I think that lenders who underwrote based upon projections of 10, 15, 2 or 3 year, 20, 30% rent growth are going to have real problems when those loans roll. And I think funds that have those projections may have a problem doing that, because when 20 million feet hits the deck, that means that there's going to be a lot of sublease space. A lot of times when guys sublet, they really don't care very much. They say just write it off, knock it out, blow it out, knock it down. So you have two guys competing for space. One is the building landlord who has numbers that he's trying to meet. The other guy is the guy who's just, and a lot of it is big financial firms, and the big financial firms, their attitude is just write it off, get it out, blow it out. The hedge funds, a lot of them will go out of business. They say $50 billion of subprime debt has hit the market so far that we know is bad. But according to the economist, there's 400 that's going to hit the market. That means there's another 350 or 300 of it that's hiding. You know where a lot of it is hiding? A lot of it is hiding on hedge fund books.
I've heard this in 1971, 1981, 1987, and 1992.
And what happened in every one of those times? You had a recession in New York.
The next up was greater than the last up.
Oh, there's no doubt. New York
so what you want to do is simply have enough capital to hold out till the next up.
Agreed. But we're talking about what will be 08. 08 will be a year of blood in the streets.
I don't agree.
And well, you're just saying you did agree. You're saying you want to hang on till the next up. The guys who can't hang on are going to get cleaned off the floor.
That doesn't equate to blood in the streets.
The guys who don't have money, what are they going to do?
The financial institutions don't have money that you're talking about?
I'm talking about the
No. Go back to what you said.
Yeah.
Hundreds of thousands of feet are coming on the market.
Right. Millions.
Millions of feet are coming on the market.
Right.
From financial institutions.
Right.
They don't have any money?
Oh, they have money, but they don't want to hang on to
There's going to be their blood?
space.
No, I think
No.
I don't
landlord's blood.
There's going to be landlord's blood. Prior to the show, Mike was saying, I like keeping cash. You prefer today to make strategic investments. I mean, we were talking just before, there is a building being traded on Madison Avenue without knowing the building. And they said to you, hey, it's $1,500 a foot. What happened in the last 20 minutes on your BlackBerry?
Went down to 11.
So this $1,500 magic number is now down to 11 because the broker who was trying to sell it to you was, trying to get the up price.
Mike, what'd they pay for it?
Oh, they made a lot of money, Norman. My guess is they paid $300, $400 a foot way back when.
So instead of making $1,500 on the sale, they're only making 11.
Yeah, but what happened to the lender?
Where's the blood?
What happened to the lender who lent on that 1,000 a foot 6 months ago?
He has a problem, the lender.
That's what we're
not the
talking about.
landlord.
And the landlord, he's going to get foreclosed on.
You're assuming he can't make a rent payment. You're assuming he can't make a debt service payment.
Let's look at it this way. Mike bought a building last year at 350 Park Avenue. You just bought a building at 280 Park Avenue. You just bought 1414 Avenue of the Americas. You guys have debt, but there are other borrowers out there, who've put more debt. You're not highly leveraged debt. I think what we're saying in certain aspects that I discussed this morning is what happens to these loans where people put a lot of debt, which is what David is saying, and they were interest-only loans, there was no amortization, and everybody was underwriting these loans both on office buildings and apartment rents on the opportunities. And what David is saying, and this is really happening, rents are not meeting those expectations. What's going to happen?
Most of what's happening in New York is that it depends on what basis and how you finance them. If you finance them too aggressively with short-term loans, you're going to have to inject equity into those situations. The bank's going to blink and roll because they have no choice, because they think it's better to do that than to foreclose and the time and effort and the disruption. Or you're going to have the asset be sold into some other person's hands. So there's no panacea for someone who put the money in, already lent the money to do it. But Norman, I think, was saying is time cures a lot of problems in New York if you think the fundamentals of the market are good. It's the people who won't get that option, the time option, and that will get hurt, I think.
I agree.
I think that there's a lot of, you can't paint everything with a broad brush as well. I mean, there are plenty of properties that may actually be leveraged, which were highly structured. So there was plenty of debt that was put on in the last few years that also had a lot of coverage artificially created with cash flow reserves that were held back by the lender. So it's possible that you have assets which might have 2-3 years of carry that are already protected and covered. And so to Norman's point, if you can hold out for 2 years because you already have reserves in place, even with high leverage, you might be sufficiently covered and be able to deal with the time issues.
And if not, these gentlemen have billions of dollars. They'll buy it at a discount.
Oh, absolutely.
But that's not blood in the street.
Well, it depends. If it's not, you know what? as long as it's not your blood, it's not blood, because it's somebody else's blood. But it's going to be somebody else's blood.
The other thing that's important in talking about, I think, 20 million square feet coming back on the market, I think, is a pretty big number, nothing that I've heard from other people.
Michael has 23 million square feet in New York City. I mean,
well, the assumption of 200 square feet per worker and that all coming back on the market is a gross exaggeration, I think. But
because
not every square foot that just because it was currently occupied suddenly becomes available for sublet or putting back on the market. I mean, these companies sometimes have guys packed in, more than 200 square foot per user. So, and that's not to say that other areas of their business also aren't growing, that they might have had an insufficient amount of space on their books currently, and so this just might be a natural shedding, which actually works well for the long-term business plan. So you can't necessarily make that assumption, and also the projections about future job losses also are very unclear. And also it's unclear that they're all necessarily all in New York City. They could be in outer boroughs or other places. But with respect to rent growth also, it's important to note, I think, that there's a distinction between making artificial rental growth assumptions and underwriting mark-to-markets. So folks might have bought a building which has rents that might be 20–30% below market currently, and as these things roll to market, you might have underwritten that NOI growth, which you're going to capture whether or not rents continue to grow beyond the just mark-to-market component, or actually grow in terms of some sort of fundamental.
Getting back to inside baseball, we have a lot of people watch this, so I don't like getting to the NOI and everything else. But what I really want to get to the circumstances, here we are, buildings have traded, office buildings at record highs.
Yes.
Now, over the last couple of months, from what I see, and statistically, the prices of these buildings are trading at a lower price, correct?
I think so.
Yeah, without a doubt.
I'm not certain that you can make that assumption.
I think the asset prices in New York are probably down 5 or 10%, but not a lot. I mean, and I think it's certainly what I think you saw before in that comment about the broker. They're certainly down about what expectations they were going to get. In other words, if the guy thought he was going to get 1,300 a foot or 1,000 a foot, maybe he's getting a little lower, because I certainly believe that that's happened. That last tick that the broker was getting on the surprise is gone.
But the story you just told, I've heard that same story a year ago. I don't think that's broker expectations trying to work the market, and they typically do that.
But unfortunately, the broker is not always being cognizant of the financial marketplace, and that's part of the problem. There are some unsophisticated brokers out there who literally believe that you can get more money. We were talking this morning about financing. How bad is the capital markets?
Well, the debt markets are absolutely horrific. I mean, we've gone from the best debt markets I've seen ever in my career to one of the worst debt markets I've seen in my career.
It was overinflated.
And it was definitely overinflated.
But there's another point here, and I've bought probably more buildings in the last 3 years in number of properties than most people around. And because of the prices, and because of the compressed caps, in every single financing deal, I had to put up an interest reserve. And the interest reserve had to cover...
Did you borrow to put up an equity?
I'm sorry?
Did you borrow that reserve or put it up in equity?
No equity. There was no choices. So you had to put up the interest reserve, and I'm assuming that any lender had to do that to any other borrower who didn't sign on recourse. So the interest reserves are there. I don't expect blood in the streets, not in Manhattan. There could be blood in the streets in St. Louis or Cincinnati.
Look, we were talking before, go back to 1990. You said you sold the last building in 1990 when we had the terrible time, the Mooney building.
Above 100 million, the Mooney building.
Mooney building for $170 million. And then there was no sales for 3 years.
Of that magnitude.
Of that magnitude. I have this group of 4 people who really are in the market, who are like 850-pound gorillas, not 800, who are out there. What do we see happening with regard to sales of office buildings, with regard to, are we in a recession, or where are we?
I think one of the things I think for 2008 is what we are definitely seeing is the market is slowing in velocity. Transactions are slowing down. There's less. It was frenetic before.
Less volume.
It was frenetic, less volume. I think that I disagree with David in so far that the rental market is going down. I don't think, and that Norman is, I think, making the point. In 1990, the difference was New York had, I don't know, it was 38 million feet of supply coming on because of sunset laws on the west side. Yep. All that Koch, remember they encouraged people to build with bonuses. you had a submarket that was oversupply compounded with a demand problem. You could have a slackening in demand in New York. You could have some sublease space, but it's not. I was the head of the space committee for Goldman Sachs. Let me tell you, that was a difficult job. We couldn't just take and come out and move everyone to one floor, so we sometimes had excess capacity. So I think that the market will slow, the rate of growth will slow. There'll be some correction, which is probably good. I don't see the rental market collapsing right now unless we have a real big problem, bigger than what David thinks. But so I still think that the public markets are saying asset prices are down. They've taken down public REITs 30, 40%. And I think that market is lagging the private market. I think asset prices are going to be lower. And returns will be higher in office. I'm just talking about office.
But let's shift focus. We spoke. David bought this item a couple of months ago, the largest purchase of extended stay hotels. New York City. Right now, everybody's building or contemplating hotels. And this morning we had Richard Bourne saying, hey, I'm waiting for the bloodbath because some of these guys were never going to be able to do it. And their numbers. You own a hotel. You don't love being in a hotel. You were going to make an office. What do you see with regard to the hospitality market in New York? I mean, you own nothing in New York as a hotel, but you own all these.
New York is a tourist mecca.
Right.
As long as the dollar is weak, you walk around Times Square, you don't hear any English. So it's always going to be, I think the biggest threat to New York hotels is if the dollar strengthens, which unfortunately is not something we have to worry about. So I think New York.
There's no blood then.
I think in hotels you're safer than.
Okay. I just want to.
When I say blood, I'm talking about the people who borrow a lot, and also when prices coming down, the froth coming off. New York is a very limited supply, but though that extra puff is going to disappear, and it's already disappearing.
Puff may disappear.
Yeah, and that'll knock $30 or $40 off those ultra high rents.
I think the thing about hotels is that we own a very large hotel, the Hotel Pennsylvania. Publicly report these numbers. When we bought the hotel, it was $11 million. It peaked before the dot-com at about $30 million. It went all the way down to $4 million after the 9/11 and the recession. And this year we'll do over $40 million.
It's amazing.
It's very volatile. That's a 10-year. It was actual numbers.
Every day you got to start the books again. It's it's not an office space with a little tenant. You can have zero.
And the Norman's point on office buildings, if you don't really have impact on the income streams, if they're still market to market because they're below market rents, you're not going to get hurt on the income streams. You might get a cap rate adjustment so that the values are not as quite as robust. So there's a difference of when the market really turns down in recession, hotels instantaneously respond. And by the way, in Hotel Pennsylvania, we track it. A lot of our froth has been driven by the foreign market and the dollar. It's been driven by the foreign tourist market, which I suspect has been driven by the fact that we look pretty cheap to those foreigners as a place to visit.
Oil is at close to $90 to $100 a barrel. David, you own an inordinate amount of retail. You own a significant amount of retail. What do we see in retail around the country, and what about the tri-state region? Michael, David?
I see retail in New York as another phenomenon that's been benefited greatly by the foreign tourists. If you look at the public companies, Saks store, Macy's store, Bloomingdale's store are reporting record increases, up 10 to 15%. The Macy's store will do more than $100 million of volume more than last year. The numbers are staggering numbers. I think a lot of that's been driven by
the
dollar and the foreign tourists.
You also have
retail in New York is great, and retail in the suburbs
you
is
have
slow.
Kings Plaza.
I think the retail.
Queens, you have a lot of.
The last
retail.
2 months, we've seen the retail market slow down quite a bit, and some of the froth coming out of that, sales numbers have reported down, and the retailers are also more cautious about their their aggressiveness because I think they're just uncertain. It's definitely a more uncertain time than it was before. And during uncertainty, people take pause. If they get fearful and they pull back, then you can have a recession. Right?
And what do you see on retail? I mean,
nationally, we saw November up 1 to 2% over last year, which is low. You know the story? There was this New York developer. He won like the mega million lottery. So they came over to him and they said, "Sam, what are you going to do with all that money?" He said, "I'm going to pay off my creditors. And with the rest, they'll have to wait."
But you own these you own these outlet centers, you own the other. What do you see in the retail?
We're seeing, actually in the outlets, we're seeing a little bit better than on the big box retail, the full price retail, because outlets by recession, people want to get a bargain. But on the full price, we're seeing 1 to 2. The outlets maybe 4 to 5, which is much below last year. I would say it's half of last year's.
But not negative.
No, we're not seeing negative.
And
It's just a slowdown.
Certainly imply that we're not heading towards anything recessionary.
Exactly.
I mean, residential, you really don't have much residential. I mean, you have that little building, One Beacon Court, you know, some other things over there. I mean, you have some, I mean, you've never really gone into the residential, right? You're really only in office.
Exclusively office.
And you, Norman?
I have one. I've had it for 15 years. 71 Park. It's the only building residential that we've owned for 15, 20 years.
Rental? Is it a rental building?
It is a condo with sterling equities.
Oh.
So where do, I mean, you know, if someone had, you know, when you put all these people together, where do we see, you know, what's the best market to invest? What's really going to happen over the next 12 months? Are the capital markets going to be adjust in 6 months? Is it going to take a year? I mean, how long is it going to take before Wall Street, I mean, that's where you came from, before we're going to clean up all the crappy debt that's been left over there?
I think it'll take, I was on several panels and people said it was going to take 3 to 6 months. That was 3 months ago. And the same guy the other day said it was 3 to 6 months, and that was the same guy who said that in July. It's definitely, you know, I've used this, the markets are clogged up and they have to open up. People have to get off their balance sheet the loans they have, and then they'll be more hungry. Right now, it's very tough to get a loan. My sense of the work that the spreads and that will work itself through next year. I'm not smart enough. It'll be the first quarter, last
12
quarter.
months?
I think it'll take 12 months. I do think what is permanently going to be lower is the amount of proceeds you can get for the same amount of cash flow in a deal. That's not coming back anywhere near that in the next. So if you had $10 and you could get $150 of leverage against that, and next year at this time of this show, I'm guaranteeing you're not getting 150 against
so wait
that,
a second.
for sure.
So
Maybe spreads will be.
So we're seeing sanity?
I think
by
it's just
underwriting?
risk return. People aren't going to take equity like risk for debt. Not going to take equity risk for debt like returns.
What do you see?
I think Mike's right. I mean, I think what really happened was that between about 2005 and 2007, underwriting standards on the lending side really deteriorated. You had subordination levels come in. You had you know, artificial reserves basically bolstering cash flows. And overall, I just think the yields also compressed to not necessarily reflect the risk.
You know.
So I think we're going to go back to where we were in 2004, which was more of what Mike said.
David?
I agree. In other words, I think that you'll go higher, lower on the loan to value proceeds, and I think spreads will always be wider.
Now, you know,
When I say spreads will be wider, I remember seeing triple Bs at 100 over, and now I'm seeing triple Bs at 800 over.
But they may come back to be 400 over.
Yeah, but it's never going to be 100.
The only offsetting to all of that, though, is that the underlying index Treasury is down below 4 now,
right?
And I think there's
what about? I mean,
you
besides being an owner, you have money for mezzanine lending. We have money for mezzanine lending. You have Park Avenue funding. Where do you see that market today? What are you going to look at? Are you going to try to lend to Jonathan or Norman?
He just did. I think the mezz market also is clogged up because a lot of guys like Dave and I don't know exactly where. We want a higher return than the borrower wants to pay for that money on new origination. And when you go in to buy paper, there's so much paper out there that you want to demand the incredible price, and the bid-ask price is spread. So there's not a lot. By the way, if you look at, there's not a lot that's traded. My wife's in the LBO, the private equity business at Goldman. She's a partner there, and when they say they're selling this paper for these deals, they're keeping $5 billion on their balance sheet. So, I mean, there's not a lot of stuff that's really moving. There's still a huge bid-ask price of the debt, and until that gets to a point where people know that neither one's going to look like an idiot, that's going to stay that way until the auditors mark that over the end of the year.
I mean, are we going to see, this year so far was $50 billion in sales, in investment sales in New York. Do you think we're going to see that type of number in 2008?
Much way.
Much
no way.
lower.
Norman?
All I can go by is what I've already seen in the last 6 weeks. I saw 31 West 52nd Street with a low cap go off. I watched 120 Park Avenue with no cap go off at $860 a foot.
Vacant building.
Mm-hmm.
500,000
not quite vacant, but almost vacant.
500,000 to 600,000 vacant. Both of those monies came from offshore. There's talk of 1177. There's talk of 398 Greenwich.
That's done. They announced it. SL Green.
Done.
There's nothing. When you see buildings come on the market and they're laying there, when you see people like Darcy Stakem or Scotty Latham, okay, come out with books and nobody bids, then we have a problem. I haven't seen that.
Wait. Mike just gave an example of a building on Madison Avenue. It's not going to trade. Maybe these people.
No, it's not going to trade at what they expected.
Not going to trade at 1,500.
Right.
He said it could trade at
So
1,100.
if a property doesn't trade for 1,500 and they're getting 1,100, your sales volume is going to go down. I mean,
Without it, look at the two biggest trades that happened in New York this year that dwarf anything. EOP and then the Maclo deal, right? EOP got 92% financing.
And Maclo got
And then
99.
Maclo got 99.5% financing.
But those are also
right?
portfolios.
So neither one of those trades would have happened in a normal environment because Maclo didn't have the money.
In my $50 billion, that did not include EOP because EOP was a sale, a different type of thing.
Okay.
But the Maclo deal
would
did.
never have happened.
Okay, but that.
Well, EOP alone was 40 billion. So
I was going to say, so it'd only be 43.
No, but we're taking that out, the EOP deal. But the Maclo deal
He's
is
counting the
included.
7 billion that came out of EOP to Maclo.
Yeah,
as a
when you
sales.
look at that, that never would have happened. So I think if you go through it and you look at the deals that traded at 80+% leverage, what percentage of deals are at 80% plus leverage?
In today's world.
60%. No, what were they this year? If you go back over the year, sorry, 70%, 65%?
Yeah, a lot.
None of them would have happened.
Okay,
Right?
question. Are we in a recession? Are we going into a recession?
I don't think we're in a recession. I think we'll see.
What? This morning you said it was a recession. Oh, you're changing it to students? You told that.
Hello, we have positive. As long as you have positive growth,
He
you're not
said
in a
we're in
recession.
economic slowdown.
But
1%
it's going to
growth.
be. It's going to get really slow. The froth is coming off. A lot of those loans are going to go. The high loans are going to struggle if they have short fuses. That's what's going to happen. But let me tell you something that nobody's considered. All you need, God forbid, is one terrorism event, and it will take this economy, and you will see it go.
Chicken Little is in the room.
And nobody is. But you know what?
Goodness.
I get paid for like Noah for predicting floods, not for putting up an umbrella once it's raining. So our job
You
is
and
to
I live
try
in
to.
different worlds.
Our job is to see what is coming around the curve. Not to say there is no curve coming. Let's just make believe
There
it's
is
not
no way
there.
to protect against terrorism. The last time, or the first time, or the only time we've had it, okay, was at 9/11. It has now been 6 years. We haven't seen it. Have you been hiding for 6 years? Have you been not buying anything for 6 years?
But we've never been so weakened. We've never had.
Weakened?
we
Wait,
have-
wait,
we
militarily?
have- No.
Intelligent?
Our
Well, that's
dollar.
terrorism.
Our dollar is
What does that
dead.
got to do with terrorism?
No. My point is that the risk of terrorism increases exponentially when it's like when you had AIDS, you have no immune system left.
Yeah,
Our
we're into
current
AIDS.
account deficit is terrible. Our regular deficit is terrible. The dollar is in the ground.
David? Are
we
you
are
selling
very
everything?
susceptible
Okay,
to
guys,
something
okay.
going wrong.
You know what? I'm saying the apple is going to stay at this level.
No, that's applesauce.
Okay, it's not going to go that low, but I'd really like to thank a great group today on my show
Wow.
talking about where they see 2008. Mike Fascitelli, Norman Sterner, Jonathan Yormack, and David Lichtenstein. See you next week.
Thank you.
Thank you.
Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, Sutphin Properties, the Wyckoff Organization, Extreme Construction and Deconstruction.